Investors often make strict demands on hedge fund managers to earn a higher return than the S&P index, and think that if the fund's earnings do not exceed or at least equal to the market return, then it has to be a bad fund. Vladislav Petlenko, Chief Investment Officer of Sigma Global Management, will present his arguments to dispel this misperception and elaborate on the most feasible and accurate way to assess the efficiency of a hedge fund. Thank you for joining us today, Vladislav. Can you please explain why this preconceived approach that if a hedge fund's earnings do not surpass or at least match the market return is incorrect?
Yeah, thank you. This is a great topic. The preconceived approach of solely comparing a fund's performance to the S&P index can be misleading. While it may seem fair during bullish market conditions, it fails to consider the fund's ability to mitigate losses during market downturns. An important aspect to evaluate is whether the fund losses are lower than the S&P losses during a market decline.
How can investors differentiate a well-performing fund from an average or a mediocre one?
There are no specific benchmarks, but to evaluate a fund's performance during a crisis, it's recommended to compare its efficiency against a benchmark hedge. Let's say one of suitable options and suitable benchmarks is the ETF SPY combined with the hedge option, such as, for example, SPY plus put option.
Could you please explain how this hedging strategy works and how it can determine a fund's efficiency?
Well, I'll try. We need to dive into the numbers. Let's consider an example where we purchase and hold a portfolio of SPY ETF shares for a year. And to hedge against losses, the investor can buy put option for SPY, paying a premium price approximately like maybe 10% of the current share price. If the SPY share price is $400, the put option price would be $40. Then we will analyze two scenarios, SPY growth and decline. Let's see how this hedge works when SPY rising by like 10 and 20% and falling by 10 and 20% as well. This will help us understand how well this hedge performs during the different market conditions. Let us assume the SPY goes up by 10%. If SPY rises 10%, then our profit from SPY ETF and put option will be 0%. However, if the SPY goes into a decline of 10%, our losses is limited to 10% which is the cost of the put option, $40. The cost that we paid as a premium for the put option. Going further, let us assume that SPY goes up by 20%. If SPY rises 20%, then our profit from SPY ETF and put option will be limited to 10%. This is because we paid a premium of $40 for purchasing the put option, and consequently it reduces our profit. $80 profit from SPY 20% rise, minus $40, which is the cost of option put, which is 10% of SPY, $40. Consequently, we will get only half of the S&P profit. So 50% is our participation rate in a profit. If SPY declines by 20%, we will lose only 10%. And the efficiency of our hedge, or so-called ratio of participation and loss, would be only half of SPY loss. So 50%. You may continue these calculations to understand hedging efficiency and growth participation rate further for this construction.
So in your opinion, What are the key considerations for investors to make when determining whether a hedge fund is worth investing in?
Investors should focus on three main points, I believe. Firstly, investors should identify a suitable benchmark against which to compare the hedge fund's efficiency. Secondly, they should assess how much the fund can earn during a market recovery following decline. Lastly, it's crucial to evaluate the fund's hedging efficiency, specifically during market crisis. Let us figure out how much a hedge fund should earn to be considered as a well-performing fund. The point is that if a hedge fund loses less than market loses in a, for example, current crisis moment, then this fund can also be considered as a hedging instrument. Let us assume that the market dropped for 20% this year, and the hedge fund where you invested was down only by like 5%. This means that your fund's losses amounted to only 25% of the total S&P loss. That means that 25% is the ratio of participation in the loss. Consequently, in a situation of 20% of market loss, your fund's loss of 5% demonstrate quite adequate performance, as it less than the loss of above discussed 10% that you would incur with SPY ETF and put option. If your fund's ratio of participation in a loss is 25% at the time of 20% of market decline, then at the time of the market recovery, you 20%, the market recovery of 20%, for example, the fund should earn at least 5% return to correspond to performance benchmark of the hedge through SPY ETF and put option. If the fund earns above 5% amidst 20% of market growth, such fund performance with hedging efficiency is better than SPY ETF plus put option position. We can continue doing ETF SPY plus put option calculations applicable to higher or lower market growth decline rates.
Thank you. You made an interesting point that if a hedge fund can limit its losses to less than market losses during a crisis momentum, it can be considered a hedging instrument. We appreciate your insights in debunking the misconceptions surrounding hedge fund performance.
You're welcome. Evaluating hedge funds can be complex, but by considering factors beyond mere performance against the S&P index, investors can identify funds with strong risk management capabilities. It's essential to recognize the importance of minimizing losses during market downturns and understanding how the fund's hedging efficiency, can provide valuable insights. Investors should conduct thorough research and due diligence before making an investment decision. So thank you very much. Bye.
Thank you very much.